Brookfield Corporation, BN, is the holding company at the top of Brookfield ecosystem. At its core, it's a capital allocator that controls and coordinates a very large and very diverse set of businesses. Today, BN oversees over $1 trillion of assets under management and directly controls $135 billion of insurance assets, as well as roughly $180 billion of discretionary capital from its own balance sheet. Structurally, there are three main pillars. First, Brookfield Asset Management, where BN owns a majority stake. This is the alternative asset manager, and it's the main fee and carry engine. Second, Brookfield Wealth Solutions, the insurance and retirement platform. This is extremely important because it brings in long duration permanent capital, which can be invested across the Brookfield ecosystem. And third, the operating businesses, infrastructure, renewables, real estate, and private equity, where Brookfield is not just a manager, but an owner and operator of real assets. One point that really matters for us and sometimes doesn't get enough attention is ownership and culture. Brookfield is run by people who have worked together for decades, with meaningful personal capital invested alongside shareholders. That creates a culture that looks much more like a long-term owner than a typical financial organization. And that shows up very clearly in how capital is allocated through cycles. So let me summarize the thesis very simply. We believe Brookfield is a high quality, long term value compounder with strong competitive advantages, multiple growth engines, a management team that is both highly competent and well aligned with shareholders, and trades at a discount to intrinsic value. The core of the thesis is cash flow compounding. Brookfield has several engines that generate cash: management and performance fees from asset management, insurance and spread earnings, and cash flows from operating businesses, which the parent company can reinvest at attractive rates of return driven to drive growth. If those cash flows can continue to compound at something like mid-teens rates over time, which we believe is achievable given the quality of the business and structural tailwinds behind it, then long-term returns to shareholders should be very attractive. What's interesting is that despite all of that, Brookfield does not trade like a typical high-quality compounder. Instead, it trades at meaningful discount, largely because of a set of qualitative frictions that affect perception and investors' awareness. The key drivers of that discount, in our view, are threefold. Number one, lack of inclusion in major US equity indices, limiting passive flows and benchmark-driven ownership. Number two, structural complexity across the Brookfield Group. With multiple listed entities, the model is inherently harder to analyze than a traditional company. That complexity discourages superficial analysis and keeps many investors on the sidelines. And finally, number three, lower market visibility relative to peers, partly driven by management's more low-profile communication style and limited emphasis on media presence, which is changing, resulting in less coverage and mind share despite comparable or superior business quality. Important to say that it's our view that the investment works even without a REIT rating. Evaluation normalization happens over time, that's upside, but it's not the foundation of our investment thesis. I want to slow down a bit on this slide because for us, this is really the heart of the investment. First, this is not one business, it's a platform. Brookfield has been deliberately built around scale, diversification, and access to long duration capital. They operate across asset classes and geographies, which reduces reliance on any single cycle or value driver. And more importantly, they have access to permanent, patient capital that allows them to stay invested when many others are forced to sell. Second, Brookfield sits at the intersection of several long-term structural trends. Growing demand for infrastructure, and here AI is largely to blame, energy transition, friend or onshoring manufacturing, digitalization, private credit growth, and an aging population that is driving long-term demand for retirement solutions. All of that on top of all these benefits associated with being in a leadership position in a consolidating industry, the alternative asset management industry. Third, and this is critical for us, is management, culture, and alignment. This is a team that has been together for decades with long dated equity based incentives and, most importantly, meaningful personal capital invested alongside shareholders. That shapes behavior. Decisions are made with a long term time horizon and a strong focus on downside protection. And what really ties everything together is capital allocation. Brookfield has repeatedly shown the ability to invest in periods of stress, recycle capital as assets mature, and redeploy it into new opportunities. This is a business designed to compound through cycle, not just perform well in benign environments. Now, with all that in mind, let me talk about valuation. At today's price, assuming continued compounding across asset management, insurance, and the operating business, we estimate a long-term IRR in the range of roughly 15 to low 20%. That's driven primarily by mid-teens cash flow growth and reinvestment, not multiple expansion of any sort. It's also interesting to point that relative to other leading alternative asset managers, Brookfield trades at a meaningful discount. Some of that is understandable given complexity, but we don't think it fully reflects business quality. And if we also look at NAV, Brookfield trades at roughly 30% discount to management's estimate. Finally, when we run a conservative sum of the parts, the downside at current prices looks pretty limited. The key point here is if Brookfield compounds cash flows at mid-teens rates, the investment works even if the valuation never fully re-rates. If the gap narrows over time, that's upside. Moving on to the next slide number 10. So stepping back, we think that the valuation gap exists for fairly straightforward reasons. Brookfield is complex. It's not in major US indices, and it's underfollowed relative to peers. That combination limits the shareholders' base and keeps a lot of investors on the sidelines. None of that speaks to business quality, but together it explains why a very strong compounding platform can trade at a discount for extended periods of time. From a return perspective, the way we think about this is pretty simple. The base case here is earnings and cash flow growth, driven by growth in fee-bearing capital, acceleration of carried interest in the coming years, compounding with the insurance business. Management's guidance implies up to 25% annual growth in distributable earnings over the next 5 years, assuming continued effective capital allocation. On top of that, there is optional upside from a narrowing of the discount. But again, we think of that as upside. Just to be clear, as it's always the case, this is not a risk-free investment. One important risk comes from Brookfield's expansion into insurance. This is a business in which Brookfield had no prior operations in a highly regulated industry and built largely through acquisitions. This introduces execution, integration, and regulatory risk. Another risk is related to the human capital intensive nature of the business. Brookfield is a partnership driven organization where senior leadership has significant influence. And any deterioration in culture, alignment, or rotation of key investment teams could gradually erode value before it becomes visible to the outside shareholders. There is also complexity risk. Brookfield operates as a multi-layered global ecosystem with complex accounting, operational interdependencies, which raises the analytical bar, even though that same complexity is part of why the opportunity exists. We're comfortable with these risks because they are understandable, largely manageable, and importantly, we believe they are already more than reflected in the current valuation. With that framing in mind, let's now move into the deep dive and unpack how this business actually works under the hood. All right, now we're really getting to the heart of the presentation. I wanted to start with history because Brookfield Past explains a lot about its behavior today. Brookfield goes all the way back to 1899, starting as an owner and operator of infrastructure assets in Brazil, utilities, transportation, assets tied directly to the real economy. That owner-operator mindset is important because it never really went away. In the early second half of the 20th century, due to political instability in Brazil, the company decided to expand globally and was later acquired by the Edward Group. Under Jack Cockwell's leadership, the business grows into one of Canada's largest conglomerates. Cockwell was a pioneer in using complex financial structures to control assets. But by the late 80s and early 90s, the group had become over-leveraged and overly complex. Then in the early 90s, recession hits, and this is a defining moment. The business comes very close to a collapse. That experience matters more than people often realize. Brookfield's culture today wasn't shaped only by success. It was shaped by almost failing, liquidity discipline, conservatism, and a deep respect for downside risk all come directly from this period. And the 1990s are really the most formative decade in the Brookfield's history. This is when Bruce Flatt enters the picture. Along with Cockwell, he essentially rebuilds the company from the ground up, divesting cyclical assets, simplifying the structure, and refocusing on high quality real estate and infrastructure businesses. But more importantly, they instill a very specific mindset, one of discipline, risk averse, and opportunistic capital allocation. Then in 2002, Flatt becomes the CEO, and Brookfield makes a crucial realization. The types of opportunities Brookfield was going after were getting bigger and more capital intensive. At a certain point, the balance sheet alone would no longer be sufficient to support the scale of opportunities they were after. So the move into asset management was a way to broaden access to high quality, patient third party capital and use that capital to leverage Brookfield's owner operating expertise. Critically, Brookfield invested alongside its clients, same assets, same duration, same risks. That alignment is central to the model. Over the following 2 decades, this model scales. Brookfield builds one of the world's largest real assets investments platform, reaching today more than $580 billion of fee-bearing capital. Then in 2019, Brookfield acquires Oaktree, dramatically strengthening its credit capabilities. That becomes critical for the next leg of growth, insurance and wealth solutions. The move into the insurance wasn't an accident. It gave Brookfield access to long duration patient capital that it could invest using the same playbook it already knew well. Now let's talk about asset management, which is the core earnings engine of the ecosystem. Brookfield Asset Management is one of the largest alternative asset managers in the world. But size alone isn't the point. What really matters is the track record. Brookfield has been investing in real assets for close to 20 plus years, generating strong, consistent fund level returns across multiple cycles to its LP space. From an economic standpoint, here, three key metrics we focus on are fee-bearing capital, fee-related earnings, and carry interest generation. Since 2019, FBC and FRE have grown at mid to high teen rates. That tells us capital keeps coming in, and that growth is translating into real recurring earnings. That fee-related earnings base is the foundation of the business, predictable, scalable, and resilient. Now, Brookfield Wealth Solution is one of the most important and still underappreciated parts of the story. BWS is a diversified insurance company built through three large acquisitions, focused on retail and institutional annuities, meaning long duration, low risk, predictable liabilities. Today, it controls about $135 billion of float, or roughly $175 billion, including Just Group, a acquisition expected to close in the first half of 2026, backed by around $15 billion of adjusted equity. That flow generates roughly $1.7 billion of spread-related earnings, which translates into a 15% plus ROE at the BN level. This is an investment-led insurance model, meaning Brookfield aims to roughly break even on the underwriting part and instead focus on actively investing the float in order to reach its spread target of 2%. What's different from peers like Apollo and KKR is that Brookfield looks to invest a larger share of its insurance flow in alternatives. That means higher allocations to private credit, but also to equity in private infra and real estate assets. For that reason, investing portfolio is structured as a barbell. That is, a large share is invested in very safe assets on one side, and another large share in higher return private credit and real assets, where Brookfield has a deep expertise on the other side. With that strategy, BWS has achieved peer-level ROEs with less leverage, which we understand as being higher quality earnings, by the way. Importantly, insurance also feeds back into the group, generating fees for them, reducing fundraising cyclicality, and balancing out Brookfield's overall exposure to the interest rate cycles. Let me now turn to the operating businesses, because this is an area that's often misunderstood. These are not fund investments or management vehicles. These are businesses where Brookfield is a direct owner and operator of infrastructure, real estate, energy, and industrial services businesses. Their primary role to the group is strategic. They provide Brookfield with permanent third-party capital, flexible financing, and they reinforce the owner-operator advantage that sits at the core of the entire platform. They are also the vehicles through which Brookfield invests its own balance sheet capital directly into real assets. Over time, these operating businesses are expected to represent a smaller share of distributable earnings. The images on this line make this tangible. Canary Wharf in London, Westinghouse, and the US semiconductor facility developed with Intel. All long-life, mission-critical assets with high barriers to entry, where Brookfield acts as both capital provider and operator. Brookfield Property Group, the real estate operating arm, is a good example of this. It was taken private by BN in 2021 at a significant discount to NAV, and it's now returning to profitability through a very pragmatic strategy, retaining high-quality trophy assets, divesting non-core properties, and recycling capital into higher return opportunities. Now let me turn back to the Brookfield Corporation. BN's role is very clear. It is the chief capital allocator of the group. What makes this capital allocation effective is the combination of a very conservative balance sheet and a deeply ingrained contrarian mindset. That pairing has repeatedly allowed Brookfield to act in moments when capital was scarce and conviction was low, leading to some of the very non-obvious opportunistic investments. If you look back, this pattern shows up again and again. In the 1990s, Brookfield acquired trophy New York City real assets, including what is now Brookfield Place, out of the Olympia New York bankruptcy. Then, after the '08 financial crisis, it partnered with Pershing Square to rescue General Growth Properties and ended up owning a nationwide mall portfolio when the asset class was widely written off. And more recently, after Westinghouse filed for bankruptcy, Brookfield acquired the company in a transaction that has since become one of the highest returning deals in private markets history. These were not obvious trades. They were enabled by balance sheet resilience, patient capital, and willingness to lean in when others couldn't or wouldn't. Because BN's main job is capital allocation, the way we judge its performance is actually very straightforward. First, planned value, or NAV. Is the value of the assets owned by Brookfield compounding over time? Second, distributable earnings. Are the cash flows generated by that asset base sufficient, and are they growing? And third, return on equity. For a capital allocator, there is no more important indicator than that. BN targets roughly 15% plus ROE over the long term, which is really the ultimate test of whether capital allocation is value accretive. Although they've been running right at the 15% mark over the last few years, we expect ROE to pick back up to the high teens range as their real estate business improves and carry realizations accelerate throughout 2026, 2027. When you look at those three metrics together, we think they tell you a very consistent story. Before we move on, I want to spend a bit more time on balance sheet, competitive advantages, and governance. Let's start with the balance sheet. One thing that's very important to understand about Brookfield is that its balance sheet today is a product of very hard-learned lessons. After what happened in the early 1990s, Brookfield became almost obsessive about not concentrating risk at the parent level. So at the end, leverage is conservative. Liquidity is ample, and the vast majority of debt sits at the asset level is non-recourse to either the subsidiaries or BN. That structure matters a lot. It means stress in one asset, one sector, or even one operating business does not threaten the entire group. We saw that clearly during COVID and again during the recent interest rate shock. Issues were contained, not systemic. This is not a company that optimizes for maximum ROE through leverage. It optimizes for survivability through cycles with a very clear priority to avoid damage the value compounding engine. Now on competitive advantages. The companies that make up the Brookfield Group, particularly BAM and BWS, have very strong moats. BAM benefits from a massive pool of permanent capital, several advantages related to scale economies, but also advantages in sourcing and investing, operating expertise, access to multiple forms of capital, and long-standing relationships all reinforce each other. BWS benefits from BAM's investment expertise and from the backing of BN's $180 billion of capital. But most importantly is the reinvestment advantage. Because Brookfield is active in so many businesses, directly via its subsidiaries and indirectly via BAM managed funds, BN has visibility to a massive opportunity set and can reinvest accordingly. While the typical company only invests in its own business, BN's reinvestment runway is almost unlimited. And finally, governance and alignment. The senior team has been together for decades. Compensation is equity heavy with long vesting, and leaders have meaningful personal capital invested alongside shareholders. So before we wrap up things up with valuation, I wanted to step back and talk about growth because at the end of the day, Brookfield is a compounding story, not a one-off opportunity. What's important to understand is that Brookfield doesn't rely on a single lever. Growth comes from multiple engines working in parallel. Asset management continues to scale, supported by structural demand for real assets, strong historical performance, and global fundraising. Fee-bearing capital and fee-related earnings have been compounding at mid to teens rates for many years. And insurance grows through the steady scaling of the balance sheet. More float invested at attractive risk-adjusted returns and provides permanent capital that reinforces the ecosystem. And capital recycling allows Brookfield to monetize mature assets and redeploy into higher return opportunities, especially during periods of stress. But together, management's long-term guidance points to mid to high teens growth in distributable earnings and cash flow. The exact number isn't the point here. The breadth, consistency, and resilience of the growth drivers is. If Brookfield can continue to compound cash flows at something like mid-teens rates over time, which we believe is very achievable, then long-term value creation should take care of itself. And that really brings us to the final question. What are we paying for this today? All right, let me start wrapping things up. But before we move into valuation itself, I think it's important to pause for a second and re-anchor on something very simple but important. Brookfield's long-term shareholder value creation history. We can talk a lot about structure, complexity, accounting, and near-term noise. But at the end of the day, this is a company that has been compounding value for shareholders for a very long time.